the thing that gives me anxiety is missing out on this mega wave that I think is about to hit, because I don't know what comes after that, guys. Like, I don't know if I'm going to get another opportunity to press this hard into something that I have so much conviction in. Like, if Amazon triples or doubles from here as part of the AI efficiency wave, like, what's next? What's the next big driver for the market? I don't know. Maybe there will be something. But I'm telling you guys, these super cycles just don't hit that often. They don't happen every few years. They happen like every 10 to 15 years, maybe 20 years.
Now, when it comes to valuations, though, I am curious because we got a lot of bears in the market as well. We have Michael Burry, who said the stock market is minutes away from a bloody crash. Stocks are still hitting record highs. We have a K-shaped economy. And people are comparing this to the 1999 dot-com bubble, that we're in that final run-up phase before everything collapses. What is your argument against that? And why could they be right?
Okay, so they're basically saying that the market is overvalued. I'm saying that the market is uneven. I'm saying, they have a big issue, I think, with the fact that 15 or 20 stocks are carrying the entire market. I look at it differently. Maybe 15 or 20 stocks are the only companies that have earned the right to carry the market. Interest rates were basically nothing in 2021. Money was free. That created a really bad environment. When money was free, everybody won, right? Bad stocks, good stocks. If you were a company, you can borrow money for free. And even if you didn't generate outsized returns, you were winning with leverage. So that was a really dangerous time. Now, interest rates are higher, which again, these guys think is a bad thing. I actually think it could be a really good thing that interest rates are higher and the borrowing cost is higher. Because when you have a higher rate environment, what it does is it punishes bad companies and it rewards great companies. So let's say you have two companies, company A and B, and they're both generating 10% on their money through whatever it is that they sell. Interest rates are 4% for them to borrow money, right? Now, let's say that the cost of capital jumps from 4% to 8%, which for a lot of companies it has. For company A, that's really bad because now instead of making a 6% margin on their money, right? They're borrowing at 4%, but they're generating 10% returns. They're only generating 2%. So they're generating a third of what they were before. That's terrible. And that's how these guys look at the market. But how I look at the market is, if we have something as big as this AI supercycle and some companies are figuring out a way to increase their return on capital from 10% to, let's say, 20%, which has definitely happened for a lot of companies, then the company that is borrowing money now at 8%, but now generating a return of capital at 20%, actually doubled what they're getting in the market because now they're generating 12% net. So even though interest rates and the cost of borrowing has increased because of the AI supercycle, they are now still benefiting. So what this does is it really punishes the companies that are not able to grow quickly because of this new AI cycle that we're in and not able to expand their margins. And I love that because as long as you're willing to pick the winners, it's a winner-take-all market for now. But again, once the efficiency cycle starts to hit, meaning all of the companies, or maybe not all, but more than 20, will start to see the benefit of AI as they're able to operate more efficiently. So even if they're not necessarily growing that fast, even if their growth rate is slow, they'll be able to generate meaningfully more profits. I think we'll see a broadening of the beneficiaries in the market from AI. And that could be the next leg up. That's my thesis, at least. And we'll see who's right. It might take a couple of years for that to play out. But I will say this, in the interim, if the market drops, it doesn't necessarily mean that they were right if the market pops back up, right? Because we've seen the market drop now, 5 times
Mm-hmm.
over the past 2 years, pretty significantly in terms of the quickness of the drop due to one fear or another that ultimately resolved themselves and turned out to not be correct.
And how could you then be wrong with your predictions? Like, what is the strongest argument against what you just said?
Yeah, so I think the thing that worries me the most is this gap between the AI efficiency wave when every company starts to lay off employees to operate more efficiently, and the time when they realize that now they can start to grow again by expanding their company, or when other people step into the market and create new companies and new industries, and that employment gets redirected in newer, better, higher paying, more creative jobs. I can't fully assess how large that window is going to be, that gap. And if the layoffs come in too big and too quickly, and CEOs and entrepreneurs and the government doesn't come in to kind of patch that gap or redirect employees to new industries and new companies and expansion, that could create a pretty meaningful recession that would hurt the market at large. That's the number one thing that would keep me up at night as an investor that's heavily levered long in the market.
What about treasury yields, though, going up to the highest levels since 2007? I think the 20-year or 10-year was as high as like 1998.
I like it. For this reason I already gave. I like it because it punishes losers and rewards winners.
But what do you say for the investors that start to question, wait a second, if I could get theoretically, let's just say 6.5% on a 30-year treasury, maybe I take some profits from the stock markets and put it in a treasury instead. Like, there becomes a point where it just disincentivizes investment in companies. Why would you take the risk? Because I've seen some where it says the risk reward of the S&P 500 is now negative when you account for treasuries paying 5.5%.
Graham, everything that you're saying is historically true. But what we're going through right now is not, we've never seen it before, right? This sort of growth. So yeah, that would be a real issue if we were just going to hop along and grow at normal rates and the market was going to be the market. But we have something that's about to hit and redefine what every economy on earth looks like. We are about to see efficiencies that we have never seen in the history of mankind. We are about to see every company on earth become meaningfully more productive than they thought was humanly possible 5 years ago. I think that people are looking at this the wrong way, and that AI is like the main character in this story, and interest rates are just like a sideshow character, right? And we're paying attention to the wrong thing. So in a normal environment, you're correct. Historically, you're correct. Interest rates go up. You can generate more from your money in a safe environment. Why would you want to take the risk to get an extra point or two? But I don't think you're taking the risk to get an extra point or two. I think you're taking that extra risk to be part of what is the most interesting, high growth, efficient capital market that we've ever seen in our lifetime. And I think that's going to last for at least a few more years. I don't know where it goes after that. So this is just not a normal environment. And I'm not treating this like the 90s or the 2000s or the 2010s. I'm treating this like something special, because in my mind, that's where we are right now with artificial intelligence.
Now, really quick, every business is asking themselves the same question. How do we make AI work for us? The possibilities are limitless, but guessing is too risky, and sitting on the sidelines is not an option, because one thing is certain. If you're not doing it, your competitors are already making their move.
And that's where our sponsor NetSuite by Oracle comes in. It's the #1 AI cloud ERP, trusted by over 43,000 businesses to manage everything from financials and inventory to commerce, HR, and CRM, all in one unified system.
When all of your data is in one place, your AI becomes a lot smarter. It doesn't just guess. it knows. NetSuite intelligently automates routine tasks, delivers real-time insights, and helps you make fast, confident decisions that actually help drive growth.
And it's not just an add-on, it's AI that's literally built right into the system that runs your business, helping you cut costs, improve accuracy, and stay ahead of the competition.
Whether your company is making millions or even hundreds of millions, NetSuite gives you visibility and control to keep moving forward. Honestly, if I were building a business of this size, NetSuite's the only company that I have 100% confidence in.
So if your revenues are at least in the 7 figures, get our completely free business guide, Demystifying AI, at netsuite.com/clips.
Again, the guide is free for you at netsuite.com/clips, netsuite.com/clips, with the link down below in the description.